In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only. And welcome back once again to all of our market rebels and options traders. And Stu,
hey,
another topsy-turvy day in the markets today, huh?
A little bit. We had a couple pieces of commentary from Jerry Powell. And the market was up and down. And
Economic Club of New York. He was doing a presentation there. And I guess he started off saying kind of cautious and then saying that it was kind of hinting, at least that's the way the market took it, that he might be done. I think the Fed future shot up to 96% chance to hold at the next meeting. And then he said, oh no, the markets are handling all of the increases just fine. And so everybody took that to mean, count that out. And boy, we sold off right about 12:30 or so, quarter till.
Yeah, you're not shocked that, he kind of double talked himself there, right?
Oh, of course, yes. That's kind of par for the course for the Fed. But anyway, another interesting day. And what we wanted to talk about is another one of our favorite topics here, Stu. And
this is a great topic. Yeah,
I know you get this a lot. I gave you a hint about what we're going to talk about, but I haven't given you the specifics. So here's the question we're going to start off with for Chalk Talk.
Okay.
So for anybody who's new, we like to kick things off with a little thought question. We'd encourage you to jot down an answer, and then we're going to come back and revisit it at the end. So here's a question. Is it better to collect $100 per day in decay or to pay $100 in decay?
I feel like this is one of your usual trick questions, Bill.
They kind of always have that lean. If I give myself away now, they kind of always have that lean that we want people to take kind of the obvious answer because that's what we hear all the time.
Yeah. And of course, the obvious answer is I want to get paid. But is it really, is it the answer? It's an answer. Is it the right answer? Or is it the wrong answer? Could you make an argument either way? This is the gist of what we try to do here, Bill, right? We just want people to consider the other side the situation and then weigh risks along with reward and weigh reward along with risks and make a better decision.
Yeah, that's what it's all about. We don't really tell people it's a wrong decision. We just want to make sure you're making it for the right reasons. And we find that so many people want to automatically jump on selling options to get this positive theta or this positive decay, and they think that that's the road to riches. So today's topic...
Pay me, yeah.
Pay me. So today's topic, positive theta, friend or foe?
Yeah, this. I know where you're going with this. It's a principle in economics, and I know you're going to get there. And if I'm right, it was something that I kind of ran across very early in my career. And when somebody explained it to me, the world changed. It just the probabilities of how things happen just became so crystal clear.
Yep.
And I think everybody's going to find this super interesting if I'm right about where I think you're going. So go ahead.
Probably are. I know we've hinted at it in Q&A. So, but you've got the gist of it, that people all think that it's about positive theta, and they don't realize that there are always trade-offs.
And so that's what we're going to kind of dive down into a little deeper dive here to find out what these trade-offs are. So let's start off with a pricing model. And right here, we've got the stock at 100, strike at 100, 60 days to expiration, 33% vol, and interest rates of 5%. We hit calculate, we get a call price of about 573. Okay. And if we look down here, we get a theta of minus 0.05, or about 5 cents a day.
Yep.
Because each contract controls 100 shares, it's really $5.
Yeah.
So the question is, notice it's got that minus sign. And the reason is that the pricing model assumes we're looking at long options that you buy. So it's a short or short theta. So the thing is, right here is what everybody focuses on. And they'll say, well, would I rather lose $5 per day? Or if I take the other side of the trade, I can gain $5 per day. Man, slam dunk right there. But as we're going to show, this is really missing a big point, a big characteristic of options that we feel.
By the way, everyone, this example, I mean, I could see Bill is using an at the money. He picked 60 days. He could have picked 30 days. He could have picked 100 days. He could have picked 33 pop volatility. He could have picked 43 volatility. He could have picked 7% interest rate, 10%, 3%. He could have picked anything. Everything, it doesn't matter, right?
It doesn't matter.
Exactly
the same. Yeah, the reason I chose kind of this odd 33 vol was I was just trying to get that close to 5, like a nice kind of round number that we could work with. So we're looking at $5 a day. All right, so that's what we're going to work with here. And before we get into the answers, for anybody who's new, please join us at marketrebellion.com/get started. We've got all kinds of great free content. Yes, you heard that right. Absolutely free videos to help you get started with trading options.
Yeah.
So let's start with time decay. So we know that it's true that option values decay over time. And it is true that's a benefit to the seller. But
maybe. Okay.
Well, again, all things being equal, you're right. But it's also a reflection of the risk to the seller. This is the part that people don't see. They just go, oh, I'm getting paid for it. Yeah, but why are you getting paid?
And sometimes if one interposes the word opportunity with risk, sometimes you get a little different spin on the situation that you're looking at here.
Yep. So focusing on positive theta is only considering the reward side.
Exactly.
There's no argument that one piece is a benefit, but why are you getting paid? All right. And that's what we're going to dive into here. So let's start with shares of stock. We're going to look at some very interesting properties of options that we think that everybody misses.
And by the way, real quick here, just for those that may not be 100% sure on this, when we talk about theta is, we talk about theta in terms of a day. That's just what it means. You know, some clown along the way decided that theta was going to be per day. You have your total amount of extrinsic value. When we talk about theta, it's how much per day we're talking about. So,
Yep. So here's long shares of stock. This is our risk graph. And along the horizontal, we have various stock prices. And on the vertical, we've got the resulting profits or losses. So
and this is for stock. This is stock.
This is long shares of stock. So what it means is that if you have shares of stock, let's say that you paid $100 for it, it crosses this zero line. Yeah. Right there. You didn't make money yet. You haven't lost money. But if it goes to 105, the
stock is 100.
Right. But if the stock goes to 105, we look left and we can see you would have a payoff of 5. At 110, would have a payoff of 10. At 80, would have a payoff of minus 20. So it's just showing us that with long shares of stock, you make and lose dollar for dollar because you're holding the actual stock.
Yeah, now, sometimes we call that a run rate. It's just one for one.
Yeah, exactly.
It's a one delta. It's never going to change. There's no curvature. No curvature. 100 shares at 100. One share at 100 is the same number of shares at 50 or 500 or wherever.
Yep. So here's what we're going to look at. Now it turns out it doesn't matter which range we pick, but I'm just going to pick from 80 to 120. And Stu, what's the average of those prices right there? Put you on the spot.
Let me get my calculator. 100.
Very good. Yeah, we've got a symmetrical distribution, all equally spaced. So it's going to be the center number right there. So it's 100. So the average stock price of the ones that I have listed is 100. And what is the payoff at that average stock price? Well, we look left, and as we just showed, it's 0.
The payoff. Remember,
payoff,
we're talking about. Yeah, go ahead.
So payoff. The payoff at the average stock price is 0.
Because you own it 100.
Yeah. And it turns out we could get fancy and do a computer simulation and pick 100 different random spaces. We're still going to come up to the same conclusion. But to make it easy, we're just going to look at this well-defined range of 80 to 120.
Yeah, real easy math. Mm-hmm.
Now, let's go and look at each of these individual stock prices and see what the payoff is individually. So if the stock is 80, the payoff is minus 20. You're going to be down $20.
Yeah, we've all done that, right? Pay 100, now it's 80. Oops.
Happens all the time.
Hate that.
Stock is 85. What's the payoff now?
15 minus.
Minus 15. Stock is 90. We're at minus 10. At 95 down here, minus 5. At 100, as we found, is 0.
Oh, let me out. Wait, I can lose 20 and I can break even. That's a good trade, right? Let me do that all the time. Let me sign up to lose 20, but when I get back to even, I'll just bail.
I'll just bail. So we can see what's happening. If we go on the other side of it, we're going to get positives. We're going to get a mirror image of those. So now the question is, if you look at this range of numbers, what's the average there, Stu?
Looks like 0.
That's what I came up with. Yep. Again, symmetrical distribution. The center is 0. So if we did that, we would find that the average of those numbers is 0. So notice what we found out here is that the payoff at the average stock price
100
is 0. And the average of all of the payoffs is also 0.
Yeah.
And that might seem a little confusing, but it's going to make more sense in a bit. So when you're dealing with shares of stock, the average payoff, that's what we saw on the vertical axis, all those numbers, is equal to the payoff at the average stock price.
Yeah.
And again, that will always be true for shares of stock. As Stu mentioned, it's because it's a straight line, never changes. It's always
never
delta
changes,
1.
Right? It's what we call curvature in the options world. The options have curvature. It's why you get those hockey stick things.
Yeah, we're going to talk about that. Exactly.
Okay.
Yep, that's exactly right. So there you go. It is not true for options. Now, what we're about to dive into here a little deeper for all of our math people, I know we've got a lot of engineers out there. It's a mathematical property that they will all be super familiar with called Jensen's inequality. But if you're not familiar with that, it doesn't matter. What matters is the principle and why it's important. So
that's what I was talking about. So when we actually had a speaker come in to speak to us many, many years ago who talked about this and explained it. And these two words here, this changed my entire outlook of the markets and of options and how to, what it meant to trade them and where the prices come from. It really changed my world.
Yep. So that's what we're going to look at. As always, one more time, marketrebellion.com/get started for all kinds of great free training materials to help you get started.
Yeah, I have to go there. If it's free, it's for me. I'm in.
I'm in too. Now, what we're about to show you here, so whenever applicable, I like to do an analogy. And with an option, as Stu mentioned, we get that hockey stick graph where it's going to be chopped off. So let me show you something to kind of lean into as we go through the examples. We're going to do something outside the options world first. Let's say that this is a back in college days, and these are some test scores. So we're not doing too well here, Stu. What's our average right here?
The left-hand one, it looks like my physics class in 11th grade.
So it looks like 80 is the average. Okay,
yeah, that was
so if you were to add up all of these and divide by 9, we would see that the average is 80.
Right.
But now let's say that the teacher says, "I'm going to give you for whatever. Be nice. We're gonna flatten out the left-hand side, everything below 80. So let's say it's at 75." You can't go below 75. So if we lose these scores and they all become 75s, what happens to our average now?
Well, it goes higher. So back in school, I'm kind of thinking about this. Like, wasn't that called a curve?
A little bit.
The teacher would curve the test scores. and sort of take off
different reasons.
The bottom ones, and therefore it kind of looked better, right? That's what's going on here.
A little bit. But what we want you to focus on is that if you start chopping off the left-hand side to be flat, it's going to boost the average. See, that didn't happen for our stock. But watch what happens when we look at a payoff diagram for an option. So here's a $100 call, and I have this at 0, which is what's called a payoff diagram. It's saying we're not accounting for the prices. We'll talk about that in a moment. But what does the option pay off? So here's a $100 call. That's our bend. So what's the average stock price across the horizontal here, Stu?
Well, I think it's the same as before.
We're back to 100. Yep, using the same range. So what's the payoff of the option if the stock is 100?
0.
All right, the payoff is 0. But what's the payoff?
Remember, everyone, Bills, you got to take the price out of it for now. Just
take the price. We're just saying, what is the option payoff?
Yeah.
So now let's look at each individual stock price, right? What we did first, we took the average and
just
we
like
fed it
before with the stock. Now we're just doing it with the option.
Right. We took the average, we're feeding it into the risk graph and saying that the payoff would be 0. Now we're going to look at the individual stock prices.
And by the way, everyone, look, why is that hockey stick there? Because the option can only go to 0.
Can only go to 0.
It can't go below 0. That's why it chops off there. It's done. Right. It's over. It's finished.
Yep.
Go ahead.
So if the stock is 100 or below, the payoff is going to be 0. So we would have 5 zeros, right? At 80, it's 0. 85, 90, 95, and 100, it's 0. That's 5 zeros. But what if the stock is 105?
5.
Would be a payoff of 5. If the stock is 110,
10.
Payoff of 115 would be a payoff of 15. And a stock price of 20, Stu, would be 20. Now take a look. What's the average over here?
Well, I can tell you it's not 0.
It's not 0.
It's higher.
In fact, if we do that, for anybody who might be doing this at home, make sure you're including 5 zeros. You got to, to divide it. And it turns out the average payoff is 555.
Yeah. And everybody, I just wasn't quick enough to do that in my head. I could have done it, but you got to do the 5 times. And there you go, 555. And the important part is it's higher than 0.
Higher than 0. That is exactly right. So remember, the payoff at the average stock price was 0, but the average payoff is greater than 0. See, that's not true for stock. And that's a big benefit with an option that you buy. Well, I know we did this with a call option, but if we did that with a put, we would get exactly the same outcome. That average of these payoffs is larger. So Bill, what does this tell us?
If I buy an option, wait a minute. If I buy an option, I'm not getting paid the theta, am I?
You are not. But why? What's the expected payoff for the call?
Well, my expected payoff is going to be 5 double nickel. But
which is not 0.
But it's not, it's not 0, but I'm paying the theta.
You are paying the theta, but the reason is you have a positive expected payoff.
Right. So that gives me an advantage because I have an expected payoff that's higher than 0, as opposed to the other side. I'm probably getting ahead of you. Am I right? I'm probably getting
a little bit, but that's exactly right. Yep. We're looking here that the average payoff for a long option is not 0. It's positive.
Look, there's 2 sides to a trade, right? There's a buyer and a seller. Your long options, you pay. Your short options, you get paid. What do you get? What are you giving up? It's always the question. What are you getting and what are you giving up?
So if we look here, the average payoff is 555. What does that mean? It means if somebody gave you 1,000 of these options, no commissions, and you didn't have to pay for them, you've got 0 cost to them. On average, they would pay off about, at least based on these prices here, pay off 555. So you're like, well, why not take it? See, that's not true for the stock. The stock could have negative payoffs, but this is expected to have a positive payoff. And that's a very interesting insight to see why you have to pay for options. It's not true.
It's totally powerful. And you could even say, look, suppose the option is $5, right? Are you going to be a buyer at $5 if you have an average payoff of 555? The answer is, of course, yes, right?
Absolutely.
How about 520? Yeah. 530? Absolutely. Yeah. 540, yeah, you're right. And when you get around to the nitty gritty, anything under five double nickel is going to be, yes, I'm a buyer. And how about over on the other side, right? 570, 580, seller.
Now you're
buyers
the seller.
and sellers, buyers and sellers. And that's what makes the market.
And that's we're going to find out why that's the fair value. That's what the fair value is telling you. So we'll talk about that in just a moment. So let's come back to this idea of a long call option. For the long call option, the average payoff is greater than the payoff at the average stock price.
Yep,
and that is always true for long options, calls or puts. And again, this is why you must pay for them. They have an expected positive payoff. And this is coming from, as you mentioned, curvature, or as we know it, gamma.
Yep. Second
so now that we've
delta of the delta. Yep.
Delta the delta. So now we've covered the long options. Now the question is, Stu, what happens with short options?
Well, I'm going to go out on a limb here, Bill, and say it's exactly the opposite.
You'd be right. We talk about that all the time, giving people a different perspective. The trader on the other side, everything is opposite. The call buyer is bullish, has negative theta, wants the stock to go up, pays a debit. The seller is the opposite. He's got negative deltas. He wants the stock to go down. He's going to get a credit. He's got positive theta. Everything is opposite. So here's our risk graph. Again, our payoff graph for a short $100 call. Now, what's the average stock price up here? Is 100.
100, yeah.
And we can see that the payoff would be 5 times 0. All of those payoffs are 0.
Yep, same place. Yep.
But now, what about at a stock price of 105?
Down 5.
Now we're minus 5. Stock price of 110. What happens
down
now?
10.
Down 10.
Remember, we're leaving everything constant, right? The price of the option before was 0. Now it's 0. So same thing.
Now, so we've got no gains in here. The only gains come from the fixed price that you're going to receive up front. So what does this tell you? If we were to take the average of all of these, exactly, it's going to be a negative payoff. If somebody gave or just threw these into your account, no credits, just said, here's thousands of these options, the average of these payoffs would be negative 555 per contract. That's why you are receiving the credit. That's because you're expected to lose that much. It's the amount of the expected loss.
Yeah, and what we say in class or what we say in coaching session is that when you sell an option, you have an obligation. You're obligated to do something. It's like a store owner you pay for a good or service, and the person on the other side, the vendor, has an obligation to provide that good or service. When you sell an option, you have an obligation to deliver stock. Period. Right? That's just the way it is. You have an obligation to deliver. So in order to take on that obligation, you're not going to do it for free, right? It's not a charity case. You want to get paid. You have to get paid for the obligation. And that's what you're getting in the theta, right? Theta just measures it per day, but you're getting paid this $1 or $2 or $3 or $4, however many dollars it is that you're selling the option for, to get an average payoff that's behind the 8 ball.
Right.
It's
right. So the thing is to realize is that when everybody harps on this positive theta, what they're not realizing is the reason for the payoff for the positive theta is that that's exactly the amount you're expected to lose on the option. That's the whole point that they miss. So for the short call option, the average payoff is less than the payoff at the average stock price. And that means you are expected to lose, not counting prices yet. And that will always be true for short options. And again, this is why you receive a credit. So yes, it is true that short options have positive theta. Chalk that one up. If you want to talk about positive theta, that's okay. Just make sure you include in the conversation that you also have negative gamma and you've got this expected loss. When you sell that option, it is expected to lose. All right, so I know it's a lot to take in. Let's do a quick comparison. And if you're at home, you might want to just take a quick screenshot or come back and watch the replay. So for shares of stock or anything that's a straight line, could be a short shares as well, the average payoff equals the payoff at the average stock price.
Right. At all the different prices where Bill was doing that all up and down.
Doesn't matter. Yep. Long call, the average payoff is greater than the payoff at the average stock price. This is why you must buy or pay money for a long call. It's expected to make money.
Yeah.
It's kind of leaning into the positive zone already based on expectations. But the short call is just the opposite. The average payoff is less than or negative, less than the payoff at the average stock price. And so, yes, it is true. You get this nice positive theta, but there's a very good reason. The option by itself is expected to lose. And that premium that you receive is exactly the amount that you're expected to lose. That's why it's called the fair value. So let's see how this can also come back to bite people, Stu. I know we get questions like this a lot, and you do with coaching sessions. Let's say we're talking about a covered call. We're going to own shares of stock. We're going to sell a call against it. Our downside hedge is limited
to the amount of dollars that you're getting.
Right. And the upside benefit is also limited because you've sold off the upside.
Right. Because you have an obligation. Yeah.
But you've got the downside risk that is unlimited. So what does that tell you for the covered call? If you're not in it for the right mindset, the average outcome is going to be regret. Now, that doesn't mean a loss. It just means that people are going to wish that they hadn't done it. So, for example, here is the covered call, which we know is synthetically naked put. We see that it has negative gamma. Here's our long shares of stock. So, yeah, if you sell this option, you're going to reduce that downside hedge a little bit. But we always have a bell curve over the current stock price. And you can see that as we dip down below this way, we end up negative. And up here, we feel regret because we're missing out on these gains.
Yeah. So that upside, it's like, you own NVIDIA at, 300 and you sold the 330 calls because they were, 10% out of the money and you thought you were safe. And now all of a sudden the stock's 400. You're banging yourself because like, oh my God, what an idiot. Why did I sell those calls?
Right.
See, that's what's going on here. Did you get, look, there is some semantics in here. Did you get hurt? Did you get killed? Did you do this? Did you do that? Look, you still, if you were hedged properly, you still made money on it. Did you give up? This is what I was saying before. Did you give up opportunity that you could have had?
Yeah.
Right. But you got paid an amount of money to give up that opportunity. It's just a business transaction.
And if it was in line with your goals, this is why we always talk so much about the goals, then we didn't have that information to back then when we did the trade.
Yeah, you can't look back.
But people do. We know that they always look back and say, oh, I shouldn't have done it. Well, you're dealing with information you didn't have then. So that's a really important step for all of you who are doing covered calls. It's not just about trying to grab the free money and trying to get the positive theta. It's recognizing that that is a step that is going to put you in a much higher probability for attaining your goal.
And you that's can't why you attain your goal until you, how can I say it, Bo? Until you state your goal. You have to have a goal, right? So in that NVIDIA example, yeah, maybe you gave up 60 points to the upside or 70 points to the upside. But if you attained your, hey, I'm looking for 10 points of alpha. And if that helped to attain that, then you met your goal. So what's the problem? I don't see what the problem is.
That's right. But people do. And that's why they start chasing it. Let me go buy it back. Let me do this. They jack up their cost basis. Now it falls. And they just end up on like a hamster on a wheel, always trying to chase it. But this is a really good example for understanding this. In this case, this negative gamma, we got the curvature where the hockey stick is inverted. Mm-hmm. And so the average of these payoffs is going to be negative. And that's why you're receiving the credit. So now we've come full circle here. Let's go back to our pricing model. For those who may not know, when the pricing model says that the call is worth 573, same is true for the put. I'm just going to focus on the call. What does that mean? It's the fair value. And what that means is that if you were to buy thousands of options just like this, not counting commissions, you would just break even. So Stu, if the expected payoff, let's say of this option was $6, what would you do?
Buy it.
You'd be a buyer. So would everybody else. What happens?
Buy. Yep.
Price goes up to 6.
Yeah.
So in other words, you have to pay for the advantage. What if the expected payoff was 5?
And then I'm a seller.
He's a seller. Everybody's going to figure that out, and they're going to sell it down until it hits where? 5. That's the whole idea of the pricing model. It's saying this option, not counting commissions, is expected to be or to generate $5.73 of a payoff. And because of that, it's going to cost you $5.73.
Yeah.
And if you want to be the short side, it is true you're going to get positive theta, but what's your expected loss? $5.73. So that's why you're getting paid the $5.73. So the whole thing with this buying or selling options has nothing, at least for professional traders, nothing to do with positive theta. It has to do with, are we receiving, it gets more about historic volatility versus implied, or implied versus implied, and trying to see if we have an edge based on the current information and the current volatilities. But you don't just sell options just because of positive theta. It's completely overlooking
tools. Look, you can use all kinds of tools out. You can use others. There's other pricing tools. There's technical, technicals. Right. You can use technicals to try and gain an advantage of which way you think your stock is going. And sure, you can make money along the way and you can lose money along the way. But at the essence of it, look, if an option is truly fair value, and I know that's like a, weird term. What does it mean? You line up 100 people are going to give you a different answer. But, if an option is truly priced at fair value, how can you expect to make any money from a fair value option?
Right. Yeah. And that's a good point. A lot of people say, oh, well, why would I buy this option? I would do it because I'm expected to make money. Well, that's senseless. If this had an average payoff of, let's say, $7, well, of course you're going to buy it. That means everybody could make tons and tons of money by always being the buyer.
Yeah, I'll pay $6.95 for that option.
I would pay up to $6.95, but would I pay $7.01?
No, I'm a seller, so my market's going to be $6.95, $7.01.
Right. So now the fair value would be $7.
Welcome to the world of making a market.
Right. It would be stuck there at $7.
Mm-hmm.
So now let's flip it to the other side. And people go, ooh, I can get $5.73 in my pocket. I get positive theta. But why are they giving you $5.73? Because that's the amount the option is expected to lose. Now, again, that doesn't necessarily mean it's a bad trade. It just means you shouldn't do it for the sole reason of positive theta.
Yeah. Yeah.
So
pretty interesting.
Do you want to lose 5? If somebody says, well, what's better, to make 5 or lose 5 per day? So if you say, is it better to lose 5 per day? It's a fair question. Make sure you finish the answer. The long call has an expected gain. Isn't it better to gain $5 per day? Well, all things being equal, but all things aren't equal. The short call has an expected loss.
Yeah.
And those gains and losses are right there. That's where the pricing model is coming up with these numbers. And what it's doing is saying, based on the time, the volatility, how much can that stock price move up or down? And it will go through and figure out all of those potential payoffs. And it says the average payoff is $5.73, and therefore you would have to pay $5.73.
And that's all a pricing model is. And that's all volatility is, right? I mean, it's no big secret. It's just, it's implied because it's in the future. We know what it was, but we don't know what the range of pricing is going to be in the future. So we, for lack of a better word here, imply it, and we put a number in there, we run it through the model, and bang, out comes this price of an option. You think it's undervalued because of, whatever you think it's undervalued, then maybe your volatility should be a little bit higher. And that's all of a sudden you'll have a $6 fair value and it's traded at $5.73. Buy it. Go ahead.
Right.
It's okay.
Right. But notice what he's basing his decision on. Things about what you are inferring about the future based on a number of things. Could be technical, it could be news, lots of things, implied volatility, but it's not, I'm going to be the seller because I get positive theta. And yet we hear that all the time from people. That's their sole reason for selling options, because of positive theta.
Yeah.
And they're not realizing this part of the equation.
Here's a little anecdotal type story, and I'll make it a quick one, right? So, in the very early days of my career back in the early 80s, it was this was like, hey man, I was watching people buy options and they were sucking down this theta. And it's like, all I heard was like, oh my God, I'm paying all this money every day. And then it was the other crowd who was selling options and they were like, oh wow, man, I'm getting paid every day. And sure, I thought it was cool to get paid every day, so I wanted to be a seller of options, which I became a seller of net seller of options. Mm-hmm. And I found over the next couple of years that program of selling options, of being short gamma, it was a difficult road to hoe in making money.
It is.
It wasn't so easy. It wasn't like, hey, I'll show up and make money every day. It was difficult to manage the deltas against the short gamma. I got to be really pretty good at it, to be honest with you. And I was able to, most of the time, successfully navigate that. And every now and then I got my, what handed to me when you had a big gap. But hey, that's kind of how it goes. Sure. But this is why it's a difficult road, because I didn't really get in the beginning that it had a negative expected payout. Right. As you're selling that option. Yeah, you're getting paid, but I wasn't really putting it all together. And, after a couple of years, it finally sunk in when somebody other than Bill, this is many, many years ago, kind of explained how this really works. And this is what's going on. Right? It doesn't mean you can't make money being short options. You just have to understand that there's another side to it, and that the expectation of the dollars is that you're going to lose money, which is why you're getting paid. And if you feel that you could manage that dynamic successfully and it meets your goals, by all means, step right into the box and say sold.
Yep. Anybody who's ever traded futures contracts knows that, not really counting the margin, but they don't have an expected gain or loss at the onset, certainly until the underlying move, which is why they have a straight line, like shares of stock. There's not a premium to pay or a credit to receive because it has an expected payoff of 0. Mm-hmm. But that is not true for the options. Yeah, and that's the thing that everybody misses. So for anybody who is an avid seller, that's fine.
What we love about options.
Just make sure you're doing it for the right reasons.
Yeah. Yeah, that's all.
With that, let's go ahead and tackle our chalk talk here, Stu. All right, so how'd y'all do? Is it better to collect $100 per day in decay or pay $100 in decay? Now, I know it's a little, now that we've gone through the demo here, a little bit of a vague question. How would you answer it, Stu?
I'm going to say I want to be Captain Kirk, and I'm going to do that test that he, passed that nobody else was able to pass, and say, look, it's the wrong question. It's the wrong question.
I kind of agree. I'm not, even though I created the question, I did it for that reason. It's not really a good question, and yet that's what we hear from people. It's because you're not accounting for the fact that if you sell the option, you have an expected loss. And if you buy the option, this question
infers that you're looking at one side or the other.
You're looking at only the reward side.
Right. You got to look at all times. You have to look at both sides, right? There's a reason why they say risk reward.
Right.
Whoever they are.
Hand in hand.
Right? They go hand in hand. You can't just make it convenient and say, oh, well, the reward's going to be, $500 a day in decay. That's stupid. And you can't say, well, I'm risking $800 to make 200 on a short iron contract. That's stupid too. Right. You got to be able to say what's both sides of it. Does the probability warrant does the probability warrant the price? And does the price warrant the probability, right? Is it better to collect, or is it better? I can make an argument for both sides of that and be
under the right conditions. Absolutely. Yeah. And that's really what it comes down to with trading.
Yeah. So maybe it's implied vol, right? Maybe the vol is at a certain spot that gives me what I believe to be an edge. So I want to be a seller, right? Yeah. Maybe I own vol, maybe I own Vega out month, and the market did something, and now all of a sudden the vols are up, and now I no longer want that piece of the risk profile, so I have to be a seller of the Vega because I'm now entering into the arena of reversion back towards a mean. So look, it goes both ways.
It does. So I hope that helps you to understand some of the complexities. The decisions and options are not always that cut and dry like people want to make them, that you always want to be a seller because you get paid. If you learned nothing else from this presentation, make sure you understand that, because that is simply not true. That's going to get you hurt. But we hope that helped, and we appreciate being here. Please join us next Thursday, 4 p.m. Eastern Time for another Coach's Corner. We'll see all of our market rebels on Q&A next Tuesday as well. And we want to wish everybody a great upcoming weekend. Hopefully we get a little bit of a reversal in our markets tomorrow, and we'll pick up next Thursday and find out what happened. We'll see you then.
And a quick shout out to my main man, Zen. Thanks for joining us, and appreciate you being here. Thanks.
All right. Hey, Zen.
Take care, everybody.